guys, welcome back to Homebuyer 101 class. This section of the course is going to cover financing basics. So we're going to be talking about getting a loan and what that process is. And you may have noticed in the course syllabus on the main page that financing comes before searching for a home. And that may seem a little curious that we would talk about getting a loan before we even find a home for you to purchase. But the reason for that is twofold. First of all, when you find that home that you love and you want to make an offer on it, what you'll need to have in hand is a pre-qualification letter from a lender. And that letter simply says two things. Number one, it says that that lender has pulled your credit, looked at your credit score, and that credit score is high enough for you to qualify for a loan. And secondly, it says that that lender has talked to you about your income that you make on a monthly basis from all sources and looked at your debts, which might be a car loan, a Visa card, a student loan, and added up those debts, and subtracted them from your income and looked at your income and said, okay, according to this income, this is what this buyer qualifies for. And on this house, they qualify to purchase your house, Mr. and Mrs. Seller. So that letter is very important to have in hand. A second reason that we want to do financing first is that once credit is pulled, every once in a while, not all the time, but every once in a while, somebody will find something on their credit report that is incorrect. It's something that was paid off a couple of years ago, it still shows it on the credit report. Or there's something on there that says that you had this loan taken out, you never had that loan taken out. Those items are fixable. The process for that is simply to write a letter, and your lender can help you with this process, but you write a letter to the three main credit agencies, or only the ones that may be just one credit agency shows a blip on that report. You write them a letter and say, this is an incorrect item on my report. They then turn around and send that to that lender. That lender has 30 days to respond and say, wait a minute, we are owed this money, or not respond. If they don't respond, it comes off your credit report. So that process can take 45, 60 days, sometimes 90 days, if there's something that you want to get cleaned up on your report, maybe to help bump your credit score a little bit so that you qualify. So it's important to get that done up front. One of the nice things is that right now in this day and age, you can apply for your loan now online with most banks or most lenders. If you have a bank in the area, most likely they have a spot on their website where you can go in and start that application process for a home loan. We have our own in-house lender that's a great lender that'd be a great place to get a quote from, that you can apply on our main page for the home buyer class. You'll look and see a link down bottom that links you to a lender where you can apply for a loan. Once you get on that website for that application process, it's not very long. They're going to ask you some basic information like name and where you live, some of your contact information. They will ask you your social security number. You'll probably check a box that says, yes, you can take my social and pull my credit. And then they'll have places where you can punch in your numbers for your income and your current debts. Once you've done that, hit send. Probably in the next day or two, you'll get a call or email from that lender that says, hey, we pulled your credit score. This is where it is. We looked at your income. This is how much house that you could purchase. You don't always have to purchase the full amount of the house. They're going to tell you if you purchase that full amount of house that you can afford, what is your monthly payment going to be? And you may not want your monthly payment to be that high. So you may back it down and say to that lender, okay, what if I wanted to pay $1,200 a month? How much house could I buy for $1,200 a month or $1,800 a month? Whatever you're comfortable with, you can talk to your lender and they'll get you that figure. Right now, minimum credit scores for most loans kind of range between 600 and 620. So those have come back down a little bit. They were a little bit higher as everything kind of turned south for a while and loans got scarce, but they've eased up a bit. So it doesn't take a very high credit score to get into a loan. We see that 680 actually qualifies for the best rate on most loans. Some loans may be 700, but 680 will get you even a slightly better rate and save you a little bit of money each month. So another reason to maybe apply online a little early, take a look and see if there are a few things on your report that if you got rid of them, would it bump you up to that 620 credit score or 680 credit score? That might help save you some money. So that's good to know up front. One question that people have a lot is, if I pull credit with more than one lender, will it hurt my credit score? And when shopping for a home loan, you can pull credit and check rates with several different banks. And just so long as you do it within a 3-month period, it won't ding your credit. They look at it all as one application process. Now, if somebody pulled credit for a new Visa card and a new Lowe's card and a new Best Buy card and a new auto loan, things like that, that can have a different effect. So as you get closer to buying a home, you want to kind of make sure that you're not making too many applications for new lines of credit, just that mortgage application. So remember to just check on the website, and there's a link there that you can apply 10 to 20 minutes online, get that taken care of, and you'll know exactly what you're facing there on the financing side. Once you've applied, lenders are required to provide you with a good faith estimate. And this is a form that the government now requires that kind of keeps everybody looking at apples to apples. And what that form will tell you is, and they'll either email it to you or give it to you in the mail, it will tell you exactly what you can expect your monthly payments to be. Now remember, for most loans, most bank loans, your monthly payment will include a couple of things, not just your mortgage. You will be paying for your principal and interest mortgage payment, but you'll also be paying your property taxes and your hazard insurance. The reason for that is, if the property taxes aren't paid, the government would take the house and the lender would not get anything. They would have made that big loan on the home, and the government would have the house, they would sell it, and the lender would not get paid. So the lender collects that money from you each month, and at the end of the year, they pay the property tax, and so they know that it's been done. Same with hazard insurance. If there was a fire and the house burned completely to the ground, most buyers would not have cash in the bank to pay off their loan with the bank. So the bank wants to make sure, if the home is lost in a catastrophe, that it's covered by that insurance. So they'll collect that every month as well. And that's kind of a convenience, because instead of paying 3 bills at once and remembering to write in 3 checks, there's just one. It's your mortgage, your hazard insurance, and your property tax. They're all right there together. We will have a sample good faith estimate in your class notes, so you can look through it and see if there's any questions that you have, but that'll talk about all the payments that you have to make. It'll also, besides telling you what your monthly payment will be, it will also tell you what money you'll need to bring to closing. It'll look at how much money you need to bring for a down payment and what your closing costs are. We'll cover closing costs a little more in the next segment, but a closing cost might be things as the attorney's fee. Do they charge $350 to do the closing for you? Your title insurance. They're going to look to make sure that your title is clear. They're going to do, that attorney's going to research the title and make sure there's nothing wrong with the title or nothing on it that would affect you adversely or keep you from buying the home. Loan origination fee. Your lender may charge 1% of the loan as a fee for putting the loan package together and doing the loan for you. Typically, you can estimate that your closing costs will be about 3% of your purchase price. So if somebody's buying a $100,000 home, they might expect that their closing costs would be about $3,000. That just gives you an estimate. A little bit later in making an offer, we're going to talk about how to ask the seller to pay some of those closing costs for you, so you can keep a little bit of that money in your pocket for new drapes or new things you want to do at the house. But we'll cover that a little bit later. But those are some of the main reasons you want to go ahead and get that loan process started, and make sure that you see a good faith estimate. And if you're looking at a couple different lenders, you want to compare one good faith estimate to another good faith estimate, and we can help you with that. Right now we're going to talk about the main types of loans that are out there at this time. There are 3 main loans that we see out there that are the most popular. The most popular one is a 30-year mortgage. It pays off over 30 years, and at the end of that 30 years, you owe 0 money to the bank, and they send you the deed on the house that they've been holding on to. That's the most popular one. People ask about a 15-year mortgage as well. That would pay off your loan in about 15 years, or right at 15 years instead of 30. So that sounds like a good idea to most people. When you look at a mortgage on a $150,000 house, going from a 30-year loan to a 15-year loan might add anywhere from $350 to $450 a month to that mortgage payment. So sometimes when buyers look at how much more money that 15-year loan would be, they opt for the 30-year instead. But the positive to that is that you can pay extra money on your 30-year mortgage and pay it off early. If financially you're able to put down another $400 a month, you can do that on your 30-year mortgage. It will pay off almost in the same time period as that 15. So that's something to think about and consider and talk to your lender about. The last loan that's out there that people use a lot is a 5-year ARM or sometimes a 7-year ARM. What an ARM loan does, it gives you a little bit lower rate and a little bit lower monthly payment for a fixed time period. At the end of that time period, your loan rate will adjust to whatever mortgages are at that time. So at this time, there are not a lot of 5- and 7-year ARMs being written. The reason why is, luckily, our mortgage rates are at historic lows. They're very low right now. The odds are that 5 years from now, when that mortgage resets, that loan rates will be notably higher. So most people are staying away from a 5- and 7-year ARM. The exception would be to that is if you were going to be here with a job or be placed here with maybe the military for 3 years, and you know that you're only going to be in that house 5 years or 7 years. It would be better to go ahead and take that lower rate. So if for some reason you knew that you were only going to be in your house 3 to 7 years, you might consider an ARM and talk to your lender about that because it would save you a little bit of money. But what you don't want to do is take an ARM, be in that house for 20 years, and have that rate reset to a much higher rate 5 years from now. And the odds are it will be higher. This is just a great time to get a loan right now. Historically, we're at just some of the historic lows on what a mortgage can run you right now. Down payment programs that we're seeing at the moment, one of the lowest down payment loan out there that's available on the market is the FHA loan. Right now they're requiring 3.5% down. So, and as an example, on a $100,000 house, that down payment will be $3,500. On a $200,000 house, that down payment will be $7,000. One nice thing about the FHA loan is that if you have family that will be willing to give you some of that money, they are allowed to actually gift that money to you. They would have to write a letter and say that this is a gift that does not have to be repaid to this buyer, and that would go to the lender. You could get some help with that 3.5%. And you could have the seller, as we talked about earlier, cover some of those closing costs for you, and that would help you get into a house with less money out of your pocket. The other type of loan that's out there that's really popular right now is a conventional loan. A regular conventional loan has a 20% down payment, so you would have to put 20% down on the property. But you would possibly be able to come in and get a second loan that's a little higher rate for 10%, so that you would just need 10% out of your own pocket to get a loan. So you can, using a conventional loan, put 10% down or 20% down or any number higher than that that you felt comfortable with. But the conventional loans are still really easy to get. Their available credit scores are right there around that low 600 number as well. So we see a lot of people doing that as well. With a conventional loan that's less than 20%, what we see a lot of the time is the term PMI or primary mortgage insurance coming to play there. If the down payment is less than 20%, the bank will require that there be primary mortgage insurance on that property that protects them in case there needs to be a foreclosure from having to sell the house for less money than they have in it. The interesting thing is that they make the buyer pay for their insurance, that primary mortgage insurance. And it can be a couple $100s a month. So most people want to try and get rid of that PMI as quickly as they can. And that's one reason why some lenders will do a second loan for 10% because they have an 80% loan with no PMI interest on it or insurance on it. And then that 10% loan doesn't have that either. So that's a good thing to talk to your lender about. Is there any way that we can avoid PMI insurance? So that's the basics of financing. Remember that you can apply online, hit that link, 10 to 20 minutes. You can do it at home at night when you just have a few minutes, and that lender will contact you and let you know where you are, and that'll help you feel more confident about where you stand as you enter this process. Thanks so much for being with us again. Our next segment, Searching for a Home, will be coming up in just a minute, And if you have any questions, remember that at the bottom of the screen, we're going to put my email contact, a phone number that you can call us at. If you have any questions at all, please feel free to get in contact with us. Thanks so much. Bye-bye.